Friends, in this video for I Thought Wealth, I'm talking to you on the topic why I take past performance lightly. As an investor, what do you do when your portfolio is doing exceptionally well? Do you start thinking that you're a genius and that you're destined to always do well, or do you start worrying what you can do better so that the good run is at least not damaged by your subsequent actions? I belong to the second school, because I know that when your portfolio does extremely well, you must always prepare for the worst, or you must prepare for a phase of adversity at least. So it's essentially a time for one to think what he can do to protect himself. So it's not a time to go to town claiming performance. Now, what I said for an individual investor just as much applies for a professional investor. It's no different. But in the world of professional investing, it's very natural for people to claim credit and try and extend that past performance into the future. When I say extend, it doesn't mean that you're going to show the same performance, but many people try to position in the minds of those who measure that performance that they will naturally deliver the same performance. This essentially is not a good strategy, because you're setting the wrong expectations. If you're doing better than what you normally expect to, what I would do as a professional investor is tell people that yes, this is there, but this is probably a one-off and it could well revert to a much more nominal return. But it's not fashionable to do it. And when investors on the other side measure performance, they don't like it. What they would like to believe is that when they see exceptional performance and then put money in that portfolio, the same performance would come in their portfolio. Now, this expectation itself is not fundamentally correct. Assume that you're buying a fund in a particular theme. Now, that theme may show super performance at one point in time. In fact, maximum investing will happen in that theme around that time. But after a lot of assets have been gathered in that theme, the theme tends to underperform for a very long period of time. We have seen this in multiple themes. We have seen this in pharma at some point in time, tech in many cycles. We have seen this in banking. We have seen it in every sector, in every theme. We have seen this in small cap, we have seen this in mid cap. Yet, that anchoring to past performance is so strong in the minds of investors that they again and again start believing or are led to believe that when they see good performance, if they invest at the time when the performance looks best, that performance will reflect in the future in their portfolio. There is no guarantee. And that is precisely why I think past performance should be taken lightly. If there is good past performance in a portfolio, go in and find out what created that past performance. Understand whether it was due to something one-off or it is due to something conceptual or structural. When you understand the reason for past performance, you start extending the logic into the future and evaluate objectively whether that performance is sustainable. When that evaluation is objective, your investment decisions based on past performance will be more rational. So, take it lightly. Don't blindly go by past performance. If you still find past performance something too compelling, rationalize it, break it down, analyze and ask yourself what caused it, and then question yourself if the same thing is sustainable. If you feel there is still a lot of steam left, then invest based on past performance. But most of the times, past performance should be taken with a pinch of salt. And that's essentially why I would continue to take past performance lightly. Thank you for watching this video.